So before it was they weren't even thinking about tapering or raising rates. Now they're starting to talk about doing things. So what's happened really in a nutshell is the rebound in the economy has been much stronger than I think anyone thought a year ago. It's hard to imagine that we would have gone from, the kind of unemployment numbers we had down to, 5% or so. And it's hard to imagine that we're going to have, 8 to 10, 7 to 10% GDP growth in the US this year. So the amount of change and the rate of change has been far greater than people thought. And in fact, I would argue that that's a credit to the swiftness of the response from the FOMC last year around March 23rd, when they really stepped up and recognized that what happened in 08 was you had monetary policy kick in pretty quickly, although nowhere near as quick as this time, but then fiscal policy was slow to back it up. And this time you had monetary policy really kick in very quickly and very aggressively in an already highly accommodative situation, and then had fiscal policy jump right in behind it. And that created a rebound that was far greater than we thought. When you combine that with the fact that the vaccine distribution had really accelerated and taken off at a much greater rate. And really, I don't think anyone would have thought we would have been this far along 15 months following the pandemic being announced last March. So a lot going on. So at the June meeting, there were some different views. This is Jay Powell's view, and it was not particularly well received last week, probably being slightly better received this week. And that is, that we have these big demand shifts that are being acknowledged and recognized and worked through. And you had these bottlenecks and other constraints on the system that we're now seeing the system reverse itself and react very quickly to the challenges. And but in the Fed's mind, maximum employment is far off still, and they're continued to be worried about the scarring that's occurred because of this crisis on top of the 08 crisis and what that means. And the other thing I would say is even yesterday you had one of the Fed presidents, Bullard, make some comments that really were not in line with where Powell is in terms of where we should go, and maybe suggesting that we should move much more aggressively in raising rates and starting the tapering. And I think the thing to keep in mind, because it wasn't just Bullard yesterday, it was also Robert Kaplan, another Fed president, who was saying that it's important to keep in mind that they are not voters. They are on the committee, but they don't vote. Not all the presidents vote. And the real votes that count are Powell, it's Richard Clarida, and it's Williams of the New York Fed. Those are the ones you have to listen to most carefully for what the policy changes are going to be and policy moves. And I think the last quote here from Powell is, their dot plot, which they get a lot of focus on, are not great forecasters of future interest rate moves, in part because of the uncertainty, but in part because all votes in the Fed are not equal. And Powell's and Clarida's and Williams are the ones that are going to matter most. So it's something important to keep in mind when you hear these guys come on CNBC and Bloomberg. They're not all speaking with the same power. So what got everyone to react? It really is the bolded areas. So first is in the upper corner, you can see the projection that GDP is, they're expecting 7% growth versus 6.5%. And that's the same for 23. And then in 24, slightly higher at 2.4%. But this is what the Fed's saying is you have this short-term adjustment process where you have this pent-up demand being satisfied, and then you start to move back down to more normal. And if we're doing in the longer run 1.8 or 2% GDP growth, that is barely break even in terms of growing the economy the way we need to grow, particularly keeping it ahead of inflation. If you go down further and look at PCE inflation at 3.4% for 21 versus when March, that's a 1% increase, or PCE up 0.8%, that's what got the Fed to start talking about things, is these are big jumps in a short period of time. But if you look out further, they're expecting this to come back down pretty quickly. And next year and the year after, struggling to be running above the 2% level that they're trying to reach. So this is a big part of what the Fed's looking at. And yet they're seeing it have very little impact on rates. So if you go to the bottom and look at their Fed funds rate versus the March projection for 2023, you're only seeing a 0.5% move out in 2023, which is a long way off to even make any determination on where you think rates are going to be. So I think there's a lot of reaction and maybe overreaction to some numbers that are coming out that are distorted. And that's one of the things that I think is the hardest part for all of us investing today, is dealing with the distortions in the global economy, particularly around interest rates and inflation rates, as you see. The one constant is corporate earnings that have continued to, after the sharp decline, be moving steadily up and project to continue to move up. So in our view, you have the three things that matter for securities valuation: earnings, interest rates, and inflation rates, and the outlooks for each of those being very favorable, with earnings looking very positive, inflation being muted at best and staying at historically low levels, and then inflation rates, while running a little hot in the near term, not being projected to run as hot over the longer term. And why does all this matter? And this goes back to a chart I showed a couple of weeks ago. But the real issue is, looking at 2000 to 2020, we had a doubling of GDP. Federal debt has grown from 5.6 trillion to 26.9 trillion as of 2020, and is going to rise again this year. Debt held by the public at 3.4 trillion to 21 trillion from 20 to 2020. But interest costs are only going up, with debt being on 3 trillion of interest costs of 223 billion versus interest cost of 345 billion on 21 trillion of debt held by the public. So if we move back up to a more normal rate, you could see between 500 billion and 1.3 trillion dollars added onto our interest costs. So the Fed's looking at this saying rates have to stay low. They have to keep them low, and we have to deal with the debt problems that we've accumulated over the last so many years. So how do we solve this? And this is the big issue for where you want to put your money, is productivity improvements are really the antidote to inflation. And what you can see in this chart is, since the late 50s up to today, tech spend as a percent of total CapEx is now over 50%. We expect that'll continue to grow. That's going to put more money being put towards productivity improvements to replace the labor that we're going to lose because of the aging of the workforces that are going to continue to go on, and the skills gaps. And this is going to be one of the big answers, and getting this right is going to be fundamental to how we move our economy out of this problem that we're in right now and start to move back to more normalization of rates and in both interest and inflation rates, and how we get back on a more normal course as a global economy. So what are the views on this? Really, the stronger reopening, its implications are you're starting to see evidence of the global stimulus starting to fade. M2's coming down here. China's starting to curtail their spending. China was very worried about commodity prices rising. So they're trying to mitigate commodity prices. So they're reducing their spending, which should slow commodity price increases. And then in the other end of the world, countries like Brazil are tightening rates because of having the inflationary pressures that they were experiencing. Those are all at play here. So stimulus is starting to come down. Supply and demand imbalances are starting to resolve themselves, and lumber is a good case of that. But there are other cases. However, we don't think all commodities are going to be resolving themselves. We think some will last longer. We think that the semiconductor chip area is one area where you're going to see an extended cycle here. We expect you'll see that in some of the materials like what Molycorp's doing and rare earth materials. They're going to continue to be in high demand because of the need for resilience in your supply chains, not just getting supply chains in balance. We think that the two leading economies are going to slow down maybe 2% next year, which is actually a positive to take some of the inflationary pressures off the system. The dollar is starting to stabilize after weakening for a good part of the year. That is actually, we think, a positive in terms of mitigating inflation. You add to that, the central banks are going to continue to be very flexible because we're in a period where there is no economic or historic precedent for what we're going through. So you actually need a central bank not to be dogmatic, but to be pragmatic and to adjust their processes to what's going on in the world around them, particularly as the rate of change in healthcare continues to get us back to a more normal environment, much faster than I think any of us expected. However, we would caution that there are going to be fits and starts on the health side as well. And we're worried about what happens maybe as we move back to the fall and start to get to some colder temperatures and more people are reopening up. How's that play out? We think innovation and technology advances are going to be critical in the coming years, but it's not going to be tech as an industry, it's tech in every industry. And we think that's going to be very important for people to keep in mind. The other thing is the Fed's already been out saying they taper first and raise rates second. Sequencing is going to be very important here and the communication on the sequencing. So what you've had now is the Fed starting to prime the pump that the market, that there will be tapering sometime and that rates will be coming in 2023 as a potential first time to raise rates. That should be welcome, not feared. If it goes beyond that, we should have real concerns as to why we're not growing enough to get any rate increases coming at some point. So I think there's a little misperception, overreaction going on. So our takeaways are inflation's going to run hotter and longer than we originally anticipated, but that's not necessarily a bad thing. You have a couple different areas, the base rate effect, commodity price increases, and pent-up demand. All of those start to mitigate and will reduce the secular concerns about inflation and put the cyclical ones in the rear view. Supply chain distortions will correct themselves because companies have to correct them. And we're going to continue to focus on the areas that make us more productive. We continue to avoid, when it comes to equity investing, the highest and lowest valuation stocks. And we think a lot of that still applies in public or private or venture investing. You want to really be careful about these companies that are so excessive in valuation that you see the big opportunity, but they're going to be hard to come by. We really want to focus on embedded companies with embedded advantages that are able to do things that other companies can't because of their financial position, their market position, or their pricing power. We think earnings are going to be more important now than they've been in the last couple of years because you had rates coming down and multiple expansion working. You don't have that at play now. So earnings growth is going to matter. And this is a time to be highly selective. So we think the digital transformation continues to be underappreciated. Innovation in healthcare is going to accelerate. Cyber and security issues are getting bigger and bigger, and we're probably spending in the wrong direction in most developed countries. We need to increase our spend of GDP probably 2 to 3% in security.
Yeah.
And then finally, you're going to have industrials and materials and infrastructure and green energy as big plays. Financials are a bit trickier in that they're in the US. Our US balance sheets for our financials are really strong. The problem is the rate environment. If we start to see a rate decline, works and mitigates against the positive changes going on there. But those are the key areas for us and the key themes. And we would say don't overreact to what the Fed speak is and don't overreact to the market news. The market generally gets the early reactions wrong. Let things settle out and keep an eye on wages and the wage bills that are going up for companies. That's going to determine where the success and failures are. So with that, Mark, I'll stop and get you back to the program.
This is the program, Stephen. You are the program.
No, the program's the next speaker. We're talking about taxes so everyone can worry about their real estate.
We will come on to Olga Loy from Winston Strawn shortly, but you've just thrown a lot at us. So let's, questions, comments?
Yeah. Hey, Stephen, what do you
what do you make of the dollar rise over, the last week or so? That one is sort of baffling to me. I mean, I've heard that it was a response to, the Fed, that they're sort of hawkish, but you read other things, it's like actually the Fed was pretty dovish, despite a hawkish appearance. And the rally started before then anyway. So do you have any thoughts?
Yeah, I wouldn't read too much into it other than it moved very one directional for most of the year until then. And, things don't keep going in one direction. So I just think it was time for a pause and a reversal of a one-way trade.
Yeah.
I do think the fact that we're talking about maybe a little more fiscal discipline and monetary discipline will shift the narrative to strengthening the dollar a bit. But I think that markets are just overreacting to everything on the short term right now.
Yeah. That was the easy one that I thought, but it's like it couldn't be that simple. So
well, but you saw it, Bill, in the value and growth trade was reversing for a week before as well. So the boat tilts too far to the side right now with the way the markets are trading. And I think it's in the short term in particular. So I think the best way to invest in this environment, unless you're an unusually highly successful trader, is to not get caught up in the short term stuff and take a longer term view. There's going to be too many people getting whipsawed.
Adam, you have a question?
Yes, Stephen, on that earlier slide, I think it was second slide, where you had the US GDP,
Yep.
2021, 7%, I think it was, 7 point something.
Yeah.
Is that right? How much
7%.
of that? Okay, how much of that 7% is caused by the distortion versus real GDP? And not so much distortion, but I'm assuming that's more of a catch-up.
Yeah, I mean the whole problem with the economy right now is it's like pushing a ball underwater, which is what we had last March when the economy was, everything was shut down. You had all this pent-up pressure building and building for the release. And that's really what the 7% is. And you saw it with China. They were the first in and first out, and they were, looking at a 10% or something for the first quarter or stronger. I think it's just when you have everything go one way, the release of the pressure has to be exerted, and that's what you see in such a big increase. And the vaccinations are a big part of that, Adam. Nobody really thought we were going to be this far along this fast with so much of the world.
Yeah.
Rob has a question. Just want to, we have to be quick, Adam. Hold
okay.
Rob Colorino.
Yeah, thanks. Hey, Steve. What was your opinion of Biden's reception by the G7 last week in the UK, and were there anything he left on the table with the Putin exchange?
And Rob, you should watch the recording. That's what we talked about last week.
I would say the reception, Rob, was I think they were happy that there was somebody new there, because they didn't really love it wasn't warm and friendly with the last G7 meetings. But I would just say that there's so many problems in each country that I think they're more worried about their own problems. They don't need the US creating more of them. So I think I think they viewed Biden as trying to be a little more conciliatory and less America first. And I think that's generally going to be well received, but it's creating some conflict as well.
Last question. Comment? And I don't mean to cut it off, but
that's okay.
Simon Vine's got this graduation of his first son graduating, and he's supposed to also kick off an event at 11:30. So Olga Loy has joined us from Chicago. She's the global tax head for Winston & Strawn. We were talking about a lot of things, and I said, why don't you come and share that at least for a few minutes, and we'll do a deeper dive on tax. So Olga, how do you see the tax landscape evolving?
Okay. So everybody's least favorite topic is tax increases and what is going to happen. I work with a lot of private equity clients, venture capital clients, hedge funds, SBIC funds. So everybody's very focused as to what is going to be happening with the Biden tax proposals. So the proposed American Jobs Plan, American Families Plan, and fiscal year 2022 budget has a number of proposed tax increases. And the major tax increases that I will highlight on the corporate level and individual level, and then you could ask questions and we could talk a little bit about it, is to raise federal statutory corporate tax rate from 21% to 28%. As you recall, previously, prior to the Trump administration, corporate rate was 35%. It went down to 21, which was the big accomplishment according to Trump. Now it's going to be going back up to 28%. That's one of the proposals. For those of you who are doing work internationally, as you recall, there's a tax that's called GILTI, okay? Because they like to come up with very interesting acronyms to make you feel bad or good, depending on what the acronym says. So the Global Intangible Low Tax Minimum Tax Rate, GILTI, will go up from 10.5% to 21%. So for multinational companies, that will be relevant. And then one of the proposals that was discussed in the news on the corporate rate and in connection with all the G7 meeting is a 15% minimum tax on worldwide pre-tax corporate book income for companies with over $2 billion in net income. So the minimum global tax of 15% for companies with book income over $2 billion. So that is on the corporate side. There's also a number of other proposals that, with respect to deductions, the offshoring jobs, the research and development. But what people have focused on the most is individual impact on individuals. So the individual income tax rate is expected to go back up to 39.6%. From 37%, which it is now, and that would apply for those who make over $452,700 for single filers and $509,300 for joint filers. So minimum tax of the tax rate of 39.6%. So here's the one that gets everybody going. Long-term capital gains tax rate will be taxed as ordinary income for taxpayers with adjusted gross income above 1 million, okay? That will result in a marginal tax rate of 43.4% when we combine it with 3.8% net investment tax. So for those of you making over $1 million, no more capital gains to the extent that your income is in excess of $1 million. There's really no mechanics of how it will be calculated, but a lot of the clients that I work with, especially in the small business community, feel that it's very unfair because, for example, if you have a small business owner that had his company, paid himself $50,000 a year, and has a once-in-a-lifetime event where he or she sells the company, in that year, he or she will be treated as a person with gross income over $1 million and will not have a long-term capital gains rate at all applied to the proceeds, which pretty draconian in my opinion. Yes, the question is, will the SALT limit be eliminated? Yes, that is one thing that people have talked about, that possibly SALT limit, that state and local tax deduction possibly would be eliminated. So another proposal that is also very controversial is that to tax unrealized capital gains at death for unrealized gains above 1 million. So that excludes some like primary residence, and it excludes gains on tangible personal property. So, and some certain exclusions for small business stock. So that's pretty controversial as well. And the 3.8% net investment income tax would apply to active pass-through business income for those earning more than $400,000. The like-kind exchanges, if you know code sections, 1031 like-kind exchanges that people use for exchange of real estate and certain other property, above 500,000 would be limited. And then here's one that my clients are all worked up about, is that the capital gains treatment for carried interest would be eliminated. So ordinary income, whether it's 1 million, less than 1 million. So that's sort of the high level of what my clients have been worried about. And in terms of the timing and effective date of those proposals, that's another big controversy. When Biden administration announced those plans to raise tax rates back in April, the thought was that these provisions would apply retroactively to April 27th. So if you sold your company after April 27th, too bad for you. You will not have long-term capital gains. So right now, the thought is possibly that's unfair, but the administration, it appears to be, does not want to make the effective date as of January 1, 2022, because everybody will rush for exits. So the thought is whenever the tax bill will pass, which people will say in June 30th, I have no idea. Somebody said July 12th, I don't know. So the thought is the effective date could be that date. So any questions?
Well, main question is when can you come back and do this in more detail with lots of Q&A?
Whenever you want. I mean, hopefully, I could do it now because.
Well, unfortunately, we have another event in 2 minutes, but
Yes.
we will do that. I told you should come give a flavor, and you've done that and more. Any quick questions? I think, Bill, you're asking for a repeat on individual rates.
Yes, it's 39.6, what it was before Trump administration, 39.6. That would be the rate that would apply for income above 509,000 for joint filers, 39.6. But that's sort of bad, but it's not as bad as getting rid of capital gains for those making over $1 million.
Olga, this is Rob. We've been clients of Winston Strawn and appreciate the relationship. Do you have any input on opportunity zone legislation change?
Well, people have been talking about whether or not the opportunity zone will survive the Biden administration's proposals, because I guess the thought was that it wasn't thought out and wasn't benefiting the right things. So I don't think it will be completely abolished, but I do think that it will be changed in some way. And so we don't know yet how it will change, but expect changes. One thing that I was encouraged by, for those of you who know what it means, the qualified small business stock, that is stock of certain small business corporations, that if you hold it for more than 5 years, you pay zero tax on capital gains. So it appears that this will survive. And if that survives, that will be the last remaining hope and the last remaining advantage for investors. Because right now,
And Olga, isn't it one of the best ways to play that, to be in a fund?
Yes, I have many funds, and especially, so the problem with a qualified small business stock, it has to be a C corporation. It can't be an LLC. A lot of companies are LLCs in private equity world. In the VC world, a lot of VC companies are C corp. So
look, I apologize, Olga.
no, you gotta go. Okay, anybody who has tax questions, call me, text me, send me a carrier pigeon. I will answer.
Yeah, she's great. And we're going to have our Chicago event on the 23rd. We did an earlier event at Winston Strawn. We'll do it again. Great space in the afternoon of the Thursday. And for those who don't know, then we're going to Michigan, Ohio, and Pittsburgh, the Midwest tour, and we'll kick it off at Olga's Chicago. So with that, Simon has a graduation for his son, and he's also our moderator. So Simon, over to you.